Consider the next question, whether the rise in inflation is going to be temporary or persistent, and what are the risks of stagflationary pressure over time. There's been this debate on whether the rise in inflation we've seen in US but also globally is temporary and due to base effects and supply bottlenecks that are temporary and aggregate demand pressures that are temporary, or it's going to be more persistent. My view is that aggregate demand is going to be strong not only in the short run but over time, given that there'll be political pressure for loose fiscal policy and political pressure for central banks to monetize these large fiscal deficits. Central banks are in a debt trap. So that combination of loose monetary policy, loose fiscal policy, and loose credit easing is going to be more persistent and structural rather than being temporary. And on the
We're going to cut in now and quickly look at what exactly that trap, the sort of debt trap we are talking about here that central banks are in. So this is a piece that was written as way back as August 2020 on Financial Times, and it says it's the catch 22 of post 2008 policy making and of now post pandemic policy making as well. To stave off a debt crisis, monetary policymakers create conditions that allow companies to borrow even more, increasing the potential severity of the next crisis. No central banker wants to encourage excessive borrowing, but equally, no central banker wants to stand by while companies default, increasing unemployment and throttling economic growth. The chosen solution to a debt crisis is more debt, said Hans Mikkelsen, a credit strategist at Bank of America. There's no escaping it. You can cut it. You cannot cut it back unless you can create a tremendous amount of economic growth to offset it. There's nothing the central banks can do. Okay, so that's what the debt trap, the debt trap is. It's a tight situation that central banks are in right now. So let's go ahead and hear what he has to say, and we will return.
supply side, my concerns are not about the short-term supply bottleneck, given what's happened with COVID or the fact that maybe labor supply is limited in the US because of unemployment benefits are going to be only temporary and phased out by September. But there
And so what do we have? That's the September 6th. It's coming up very soon. The $1.9 trillion American Rescue Plan passed in March 2021, I believe, renewed the federal boost to jobless benefits, giving recipients the extra aid on top of the assistance received from the state. But 26 states have decided to stop the federal benefits before the official cutoff dates. So this folks here on cnet.com says what will happen to federal unemployment benefits. Okay, what will happen to that? So when do federal unemployment benefits expire in each state? Okay, and what is going to happen? Well, who knows what's going to happen? Will they increase more? What will be the outcome for those who haven't found a job yet, or the gig workers who normally don't qualify for unemployment insurance? Could there be a push to extend the benefits past September? We'll continue to update this story according to them. Okay, it says, and then under this, when do federal unemployment benefits expire in each state? Citing labor shortages, 26 state governors, as we indicated, said pandemic-related unemployment benefits were producing limited incentives for workers to take jobs, and some economists have cited that as some of the reasons we are having some of the wage inflation we are having right now because of the supply shock of labor a lot of employers have had to hike employment costs. They've had to hike wages. I think McDonald's is probably one of them. And they were citing the fact that there weren't workers available. So many analysts and economists have disagreed, noting that several factors have prevented people from finding suitable work, including low wages. So that's a counter to that. So well, yes, it could still be. The fact that McDonald's has hiked wages may not necessarily mean that it's still not low. It may still be low wage, even though they have hiked it or may have increased it. Okay, so lack of childcare, which definitely there's no dispute about that. Even in good times, it's a problem. It's a problem. Childcare and the cost. Even if you find it, the cost. And if you have the money to pay for it, for childcare, also another issue is also time. And then fear of contracting COVID. Okay. The premature cutoff of benefits in those states affects over 4.7 million workers who have been relying on the $300 weekly supplement throughout the pandemic. Of those workers, 2.3 million will no longer receive any state or federal unemployment aid. Okay, that's what we're facing right now. That's what is looming. September 6th, 2021. That's when the U.S. federal income benefit will come to an end.
There are 9 potential negative supply shocks that are more medium, longer term. They can be stagflationary for the global economy. Reduce
9 stagflationary. Okay, the 9 potential negative supply shocks that are about medium to longer term. So the 9 of them is that okay, amongst other things they would do is that they can be stagflationary for the global economy, reduce growth, increase costs, and if you have lose monetary and fiscal policy on a persistent basis, then that can lead to stagflation, inflation, recession. So the 9 points he was going to read there, I'm going to read it for you if you don't mind. Okay, these 9 points, just to repeat them briefly, are the globalization and protectionism, reshoring of global supply chains towards high-cost parts of the world, aging of population, advancing economies and emerging markets, slower migration restrictions on migration from south to north, decoupling between US and China, global climate change that increase the cost of production for any good from any good, starting with food and agriculture, pandemics that lead to self-reliance on domestic production, restriction to exports, cyber warfare that damages production and causes supply shocks or leads to firms having to spend a fortune on IT services to avoid cyber attacks. Okay. And finally, the backlash against income and wealth inequality is leading to more progressive fiscal policies and labor policies defending workers, wages, and unions. Okay, so I'm afraid if I play this now, we may continue from where we may continue from what I've just read. But regardless, we will forge on and see what we can make out of his
growth, increase costs, and if you have loose monetary and fiscal policy on a persistent basis, they can lead to stagflation, inflation, and recession. These 9 factors, just to repeat them briefly, are deglobalization, weakness of growth driven by weaker sentiment and weaker aggregate demand might be relevant, especially in the second half of the year, and that might be keeping inflation at bay. But over the medium term, I worry that negative supply shocks that I described will be inflationary, and at the same time, over the medium term, we'll still have strong aggregate demand because of loose monetary, fiscal, and credit policies. Now, one of the paradoxes may be that the recent growth scale we've seen in the market might lead the Fed to become more accommodative for longer, no tapering this year, and normalizing rates later than otherwise. It might lead to a bigger fiscal stimulus that Biden needs, of course, to win the midterm election, the $4 trillion plus of proposed infrastructure spending. That will keep.
Okay, so this brings us to yes, it brings us here. That is where he said, now one of the paradoxes may be that the recent growth scare we've seen in the market might lead to the Fed to become much more accommodating for longer. So you can see here, okay, this is as it concerns the recent FOMC meeting. It says Powell said here, however, the central bank has said any such tapering would require additional improvements in the economy. And Jay Powell, Fed chair, said there was more ground to cover before it acts. So we expect further progress, and we expect that things go well. That if things go well, then we will reach that goal, Powell said. And when we reach it, and the committee is comfortable that we have reached it, and then we will taper at that point. Okay, so they're not there yet, so that's just a validation of that point he made over there. So we will just return to the video, to his presentation.
Remain strong over time in spite of the recent growth scale. So I'm still more worried about the inflationary and stagflationary pressures, especially for United States. What's the outlook for macroeconomic policies? Next question. Monetary, fiscal, and credit policies. In developed countries, policy on the monetary side are still quite accommodative, but there is now differentiation between three groups of central banks. Those are becoming more hawkish and phasing out of QE, gradually tapering or signaling rising rates soon. Norway, in Canada, in the United Kingdom, in New Zealand. Then a group of countries that are still dovish, continue with QE and very low rates, and with a bias towards easing more. ECB, BOJ, Swiss National Bank. And then you have in the middle of the Fed, you have another FOMC meeting next week. And the debate, of course, is after the relatively hawkish June FOMC, when the Fed is going to start signaling tapering, when we'll start normalizing policy rates. My assessment is that the risk is that in Europe, where the credit guarantees were occurring done by the fiscal authority at national level rather than the central bank, they may be phased out too early. And as I pointed out, this credit easing has helped markets, banks, non-banks, credit markets, high yield, high grade, corporate debt, money market, commercial paper, and even broker dealers. Of course, concerns about moral hazard and whether we build out again Wall Street rather than Main Street. That leads me to my final observations. What is the outlook for markets and asset prices, and is there inflation trading in trouble? And what's the risk of a correction in risky assets?
Reflation trade. So let's quickly find out the reflation trade. Okay. In markets, the term is used liberally to define an uptick in growth and price pressures after a broad contraction, often referring to the rate of change rather than the absolute level of prices. Reflationary trades tend to involve assets exposed to faster economic growth, price pressures, and high yields. Okay, so that will, some of those, obviously those assets are include stocks, equities, bonds. Those are fast. They react faster. They're much, they exposed to fast economic growth. Yes, price pressures and all. Yeah, so yes, it does include them, and we have seen that happening a lot. Okay, markets reconsider the inflation trade. What's inflation trade? Let's go ahead and find out again. Inflation. Okay, let's look at reflation definition here from Investopedia. What is reflation? Is a fiscal or monetary policy designed to expand output, stimulate spending, and curb the effects of deflation, which usually occurs after a period of economic uncertainty or recession. The term may also be used to describe the first phase of economic recovery after a period of contraction. So this makes this definition adds to the one we read earlier on. So you can see it just with the trade will just simply mean that the trade that is associated with monetary that is associated with monetary policy implementations or changes and all that stuff. So definitely the stuff the likes of bond trades, shorting and going long or shorting them, equity transactions going up and all that stuff, or rather placing transactions or getting transactions done in reaction to these policies. So those are just in a nutshell reflation trades. So we just had to, we're obviously reacting, so that's why we had to cut you short on that and bring you that.
Inflation strategies since the beginning of 2021 were there and they worked for a while, but now they're struggling. The idea was that as the global economy recovers and you have a V-shaped recovery, you should move from bonds to equities as bond yields will rise, from bonds to credit as default rates for private sector fall, from credit to equities, from growth stocks to value stocks, from defensive stocks to cyclical stocks, from US to Europe and emerging market in equities, from the dollar to other currencies, towards a rising price of oil, energy, and other commodities, and instead having weakening of safe haven assets like gold, like safe haven currencies, of course, long duration bonds with yields rising. However, recently, in the last few days, especially last week between July 12 and 19, things have changed, and there's been a bit of a capitulation of this reflation trade, mostly in the bond market, but also in the equity markets. We've seen risk off given a growth scare because of the Delta variant and some of the weaker data. Bond yields much lower in the US and globally. Equities correction of 3.5%, stronger dollar, gold moving sideways to slightly higher, credit spreads staying still relatively low, and oil and commodity going lower. So what's going on? The most interesting thing has been the fall in bond yields. The bond yields at the beginning of the year were 0.9 for 10-year US Treasury, went by the spring to 1.7, but since then they've fallen from 1.7 to 1.2% in the last few days, even lower, 1.17 yesterday. So about 50 basis points fall in long bonds. Now, what is it due to? Part of it, about a little more than half of it, is due to a fall in inflation expectation. Break-evens have gone from 2.6 to 0.3. So of the 0.5 fall in bond yields, about 0.3 is due to lower inflation expectations. But even real yields have fallen by about 0.2%, from minus 0.9 to minus 1.1 for the 10-year real yields for the United States. So the fall in nominal yields is due to both a fall in real rates and a small fall in inflation expectation. So why
I had to jump in there and also clear out what is really what. He mentioned there nominal rates and real rates. So nominal rates are interest rates that are just designated. That's already specified by the central bank, and then that's just what it is. What it's it's just the nominal rate. It's not, there are no adjustments to them, no adjustments as it concerns inflation. Those are just the nominal rates. They just designated and indicated. So the real rates are when all the adjustments and deductions are made, then you get the real rate. So we have to intervene there and bring you that definition while we proceed.
We get a fall in yields in spite of the fact that inflation has been much greater than expected. CPI, PPI, PC in the United States, but also in some other advanced economies. There's a variety of explanation. Number one, there's a growth scare given the Delta variant and the spread of the contagion. Two, there's a view that maybe the inflation surge may be temporary and due to base effect. Three, the Fed might have convinced markets that the inflation surge is temporary and that might have pushed lower.
Just if you probably just on Wednesday or yesterday to Thursday, the 29th of July, the Jerome Powell, the chair of the Fed, has just come out to indicate that he doesn't think that inflation is going to be temporary anymore. So this presentation Nouriel Roubini made was as at 2 weeks ago. That was on the 20th of July. So this presentation has obviously it was in the past. So that's why we are just cutting in now to indicate that the Fed, as at I think the 28th or 29th of July, indicated that they now think that inflation will no longer it's not going to be temporary. It's going to continue. Take the fact that, for instance, utility bills, real residential bills, your mortgage, okay, especially your rent, for instance, and your utility, just the two of them, your rent and your utility. Take those two figures. They don't come down. Have they ever come down? They rarely do come down. Once they go up, they stay up. So it's amongst other things because they are relevant. For the production of the goods and services, we need some of these, costs, rent and utility bills. They are all part of it. So we just had to cut in again and point out something there. Okay.
Inflation expectation. For the hawkishness of the Fed in the June FOMC led to lower inflation expectation and long yields falling. 5, and more interesting, people are starting to worry that the Fed may make a policy mistake. And the interesting thing is that when people talk about the Fed making policy mistake, some people think about a very different type of policy mistake from others. Some worry that the Fed is going to tighten too soon by exiting starting tapering, exiting policy rate too soon when the economy is still weak. That would cause a recession, and if a recession occurs, rates are going to go lower. So that might be the policy mistake. Fed too hawkish too soon. The other opposite view is that the Fed is going to tighten too late, is too loose for too long, and by being behind the curve, that's going to cause inflation. And then once inflation rises too much, the Fed is going to have to fight inflation and tighten policy, and that will cause the recession. And once that recession occurs because the Fed is behind the curve and fighting inflation, again, that is going to lead to lower policy rates and lower long rates. However, there is a third possibility. What if the Fed is behind the curve and inflation rises and the Fed doesn't tighten enough so that inflation expectation rise, actual inflation rise, and long-term interest rate rise? Market today don't seem to be considering this option, this risk, but in my view, that's one that actually could be a surprise in the next few months. Of course, there are also some technical factors that led to the fall in bond yields. Those hedge funds were short duration of bonds because of the reflation trade that now to cover their shorts because long bond yields are starting to fall because of the reasons we said. So that capitulation trade might have exacerbated
Explained what that capitulation trade is all about here, and it says, let me find out. Okay. Okay, of course, there are some technical factors that have led to the fall in bond yields. Those hedge funds were short duration bonds because of the reflation trade. So what does that mean? What does that mean? They were short duration. Okay, they were short duration bonds because of the inflation and trade that are now have to okay they are now okay they have to now cover their shorts. Okay, so they sold the short duration bonds that will be, I think it includes probably 10-year bonds. I think I'm not exactly sure whether the 10-year bonds they don't it's did it short duration. No, 10-year wouldn't be that 10. It's sorry about that. 10-year wouldn't be short duration. Probably anything less than that. The 3.5 years and all that stuff. Okay, let's quickly have a look and see short duration bonds, if you don't mind. Let's not just speak off the top of our heads. Let me not speak off the top of my head. Short duration bonds. But short duration bond. Okay, so what is short duration bond? Short duration is generally bond with a short time to maturity. Short-term bonds generally carry less uncertainty because the principal is repaid more quickly and can be reinvested earlier on. However, the duration is not okay. So for them to be shorting short duration bonds, it just simply means that it has reason. You know, they expect it to. They don't expect it to be where it is. They don't expect it to be where it is, and they amongst other things, they expect it to fall as well for them to have shorted it. You know, because if they short it, they will expect it to fall, then they'll buy it back. You know, that's and obviously since they have done that, and it's not the case, and they're probably buying it back. It says technical factors that have led to the fall in bond yields. Those hedge funds were short duration bonds because of the inflation trade that they now have to cover those shorts because long bonds are starting to fall because of the reason he said. So the capitulation trade might have exacerbated the market dynamic and pushed the 10-year yields even below 1.2%. Okay, let's continue from where he stopped.
The market dynamic and pushing the 10-year yields even below 1.2%. My view, as I pointed out, is that there is a market mispricing. Bond yields are going to go higher in the second half of the year as growth and inflation are going to surprise on the upside rather than the downside. I have this view that there are forces of aggregate demand that are still strong, that supply bottlenecks are going to be stagflationary, and the combination of that aggregate demand shocks and aggregate supply initially leads to overheating and inflation and eventually leads to stagflation. However, if you want to be Solomonic, you have to consider three scenarios that have different implications for safe assets and risky assets, for bond and for equities. Number one is the following one. The growth scare is for real, it's not just a scare. Growth will fall, inflation will fall, therefore, as there is a slowdown of global growth. In that scenario, bond yields will fall, but then will be in risk off, and equities correction that we've seen in the last week is going to continue because we have a sharp slowdown of global growth. And that implies that reflation trade fizzle out, not just for bonds, but also for equities. Second scenario is that the growth scare is only a scare, that growth resumes, becomes robust because of the reopenings and controlling new cases and having vaccination rates. Global growth expands, but maybe inflation rises temporarily the way the Fed thinks of it. There'll be the best of all worlds. You'll have a resumption of those reflation trades, bond yield rise but only modestly, both in nominal and real terms. But as you have the reflation trade and growth is expanding, but inflation is rising only gradually, and the rise recently is only temporary, equities go even higher, even if they are a bit overpriced right now. Third scenario is one in which growth resumes and inflation is persistent, is not temporary, and therefore the Fed was wrong in believing it was temporary. Then if growth resumes and we have stronger demand growth, and eventually we have supply bottlenecks, and we get inflation, and then eventually stagflation, then what happens to the market depends then on the Fed. And there you have two scenarios. If the Fed remains dovish and behind the curve, long bond yields go higher in nominal terms, but not in real terms, and for a while stocks and equity go higher as the Fed is still loose, and they go higher until inflation becomes a serious problem. Once inflation becomes a serious problem, then equities start to fall because long yields go higher in nominal terms, but also in real terms as inflation risk premium rise. So eventually, letting the inflation go out of hand is bad for bonds, but is also bad for equities. Second scenario is that if the Fed was wrong and inflation rise is not temporary, more persistent, then if the Fed becomes hawkish and tries to fight inflation, then expected inflation would fall because the Fed fights inflation, but the real yield will rise because you have tight monetary policy, and nominal yields go slightly higher because inflation expectations are slightly lower, but you have a rise in real yields as you have tighter monetary policy. But then in this situation in which you were behind the curve for a while, inflation got out of hand, but then the Fed is forced to try to fight inflation and tight monetary policy, equities correct sharply as you get the Fed tantrum and a taper tantrum, and real rates are rising. So my point is, in two scenarios out of three, you can get a correction of equity markets. One is the growth scale is for real, growth is faltering, inflation is lower, but then equities are overvalued because there is not as much growth and profit, or inflation is a serious problem and the Fed is behind the curve, inflation gets out of control, but then equities fall because inflation risk premia rise in one scenario, and eventually the Fed has to fight inflation, tightens monetary policy. And if the Fed doesn't become hawkish and tighten monetary policy and inflation gets out of hand, then inflation is out of hand, and eventually the rise in nominal and real yields because of the inflation risk premia kills the recovery of growth and leads to a correction in equity.
That's I'm afraid the much we can cover on that. There's a lot of scenarios he talked over there, and how I wish we could expand more on that. How I wish we could. Let's see, but then inflation. Let's look at inflation risk premium. Let's see. They even have bonds for that. Okay? Inflation risk premium is a measure of the premium investors require for the possibility that inflation may rise or fall more than they expect over the period in which they hold the bond. Both the real risk premium and the inflation risk premium can be interpreted as investors can be interpreted as investors' assessment of risk. Okay, so the real risk premium, obviously, which will be the absolute premium, and then the inflation risk premium itself can be okay. Yeah, I wouldn't exactly define that. Okay, so how's inflation premium calculated? Okay, so let's see whether we can pick out any other term there and have a look if we can piece this out. Okay, rise in nominal and real yields. Whether okay, let's see now. Nominal yield. We have looked at nominal rates. Let's look at nominal yields. Okay, nominal yield is the coupon rate on a bond. Okay, so what is a coupon rate? Essentially, it is the interest rate that the bond issuer, okay, it is it is the interest rate that a bond issuer promises to pay bond purchasers. So that's the nominal yield. Okay, that this rate is fixed and applies to the life of the bond. Sometimes it's referred to as the nominal rate or coupon yield. So remember that nominal is usually designated, and then real is what is absolutely the real thing itself. So let's look at real yield. So yields on inflation protected government bonds are considered proxies for so-called real yields or expected return, okay, that investors can get on either nominal or inflation adjusted government bonds when accounting for for expected inflation. Okay, so real interest rate, okay, real yield calculated. What's real return? Let's see. Mm-hmm. Okay, real yield obviously has to be yields on inflation protected government bonds are considered proxies for so-called real yields. Okay, so we didn't get a much more obvious definition for real yields, but it's a color is it should be a corollary to that, but not exactly perfect, not exactly a perfect corollary. Forgive, you know what I'm trying to say. So okay, we have looked at risk premium. What else can we just quickly have a look before we round up? We have looked at reflation trade. Okay, let's okay, well, we wanted to have a look at being behind the curve, which is not acting, just being a bit Fed remains behind the curve. Okay, that will be a case okay, let's see if we can get that case. Fed behind curve meaning a central bank gets behind the curve when it is not raising interest rates at a pace fast enough to keep up with inflation. Conversely, the Federal Reserve can get ahead of the curve by increasing interest rates at a pace faster than inflation suggests it should be. I think right now the Fed has been doing that. It's ahead of the curve at the moment. I think that is, amongst other things, he explained in this video that the market, the expectations right now are that inflation it's not going to be inflation expectations are a lot more dampened. So meaning that currently the U.S. Federal Reserve is ahead of the curve, not behind it. So it is definitely not okay. Yeah, whatever it is, but right now it's not really raising interest rates as such. So but in any case, the implication, I think, the implication is that since the market's expectation inflations are now dampened, I think you can actually say that yes, the Fed is not behind. It's not behind, probably on top of the curve. Yes, I think, even though this definition on Investopedia is saying that it's when the federal central bank is not raising interest rates at a pace fast enough to keep up with inflation. So, well, well, okay. Let's quickly have a look and see what the current inflation rates are. What the current interest rates are. There's no chance we're going to get any figures, any sort of figures. Let's see US interest rates, Financial Times. We don't have anything there. Let's see. Okay, this is the 28th of July. Okay, so actual, previous consensus, so it's still 0.25%. So I think it hasn't really gone up. So we can simply conclude that the Fed is behind the curve. It's not raising interest rates fast enough to control inflation, is it? Not raising interest enough to control inflation. Inflation is rising, so it's not controlling enough. So it's not. It may not be exactly what the case is. It's not a case of whether it is behind the curve or not. That hasn't really come up in this case now. So in any case, that's the much we can do, or rather I can do in this review. I'll keep on trying to improve and make it more interesting for you. Okay, so thank you very much for watching this video.